Sorry.
I've started recording.
Fantastic. Well, welcome to the first in a series of becoming a better, more educated property investor. I'm Paul Stoner, CEO of Biggin & Scott, and today we're joined by Bradley Beer, who is the CEO of BMT, Tax Depreciation. Welcome, Brad.
Hi, Paul. Great to be here, as always.
Thank you so much for joining us. Brad, one of the mysteries of property management is the depreciation and how it works, and who can arrange a depreciation schedule. So thank you so much for joining us. I know you're going to run through a presentation and then maybe we'll ask you a few questions. I know I've certainly got a few. So thank you so much for joining us.
Great to be here. Thanks, Paul. It is something that, and thanks, Biggin & Scott, it is something that investors and property managers and real estate professionals across the board often don't understand fantastically. And you know, the core thing is it makes a big difference to the cost of owning property. It's worth a fair bit of cash. So investors are buying properties, as you guys are, for the purpose of making money, and depreciation makes a big difference to that. So let's unpack it a little today. I think I'd like to talk a bit about what it is, what it means first. Then we're just going to run a bit of a cash flow to show what happens if you do or don't claim depreciation. A little bit of technical about how it's done, and then just run through some of the tools that I guess help with depreciation on the property investing journey. BMT, been around for 27 years. I've been here 26 of them. From a little spare room to now a business that's done nearly 1 million depreciation schedules and about 200 or just over 200 staff. So, been an interesting journey, done lots of depreciation schedules, saved lots of investors lots of money. So, what is it? What's it about? I think the easiest way to explain depreciation, I think, is to talk about a car. We understand depreciation in cars pretty well because we buy it, we drive it out of the shop, and suddenly it's worth less money and keeps getting worth less money over time. Depreciation on properties, similar concept, except we want the property to go up in value, of course, because that's how we make some of our money. We make it out of capital growth, we make it out of cash flow. Depreciation's on the cash flow side, capital growth is appreciation in value, but the building itself wears out, just like your car does. The carpet wears out, the stoves, the blinds, the bricks and mortar wears out over time. And the tax office calls that a decline in value or depreciation and allows a property investor to claim an amount of money based on that. It's based on some of the cost of the building, and it does mean a significant amount of deduction for people that own properties as investment. You can't claim it on your principal place of residence. You can claim it on any residential or commercial property that's actually rented out or used for your business if it's a commercial property. So it means a lot of money, makes a big difference, and I think it's pretty easy to see why once we run through some of those numbers, we should think about depreciation as property investors. I'm a quantity surveyor, so I guess the question of why we get involved in this is one that's there, or what is one of those is probably the first question. Quantity surveyor is not an accountant, it is someone who, I've done a building degree. We come out as a quantity surveyor so we can, and what we do as a quantity surveyor is we actually measure and estimate the costs of buildings. So someone who has a set of plans can give them to us. We can count the bricks, measure the concrete, count everything in there, find everything in there, and work out what it should cost to build. From there, the tax office, being that depreciation claims relate to the construction cost and the value of things in the property, the tax office will accept the numbers come up with by a quantity surveyor for construction costs. So when we do that, there's a piece of compliance. So the tax office says, where'd you come up with your construction costs? Or if they're auditing you, they ask that question. We've got a report by a quantity surveyor that says it should cost this much to build. If you don't have the actual costs, they'll accept the quantity surveyor to come up with those numbers. We also need to make sure we understand that piece for compliance and construction costs, but know how to maximise those deductions. So we need to kind of put those two sciences together. One is construction cost, and the other piece is the tax rules. How do we get the most out of it? So you need a quantity surveyor who specialises in depreciation. We work alongside the accountant. We're not the accountant. We are the person that comes up with the construction cost and does that, just that little piece of the tax return. Now, the Institute of Quantity Surveyors have spent a bit of time with the industry in trying to, I guess, keep it so that quantity surveyors understand depreciation well, and they put together a paper on the way things should be done. And I'd just like to raise it because a lot of time lately, especially since COVID, especially on the second point there, the purpose of a site inspection is to go and visit the property, obviously, and then come up with the construction costs that we can, I guess, back and be sure that we get everything and maximise those deductions. And a lot of, I guess, our industry has been doing it off photos and doing it without going to site for whatever reason, because it was much easier in COVID. We've stuck by making sure we go to do these inspections and get the maximum deductions and making sure we can stand by those things that are put together. The other thing is referral fees. And one thing that happens through the industry a little bit is that quantity surveyors will sometimes pay for referral fees. Biggin and Scott gets nothing from this. We don't pay them any fees. They're just coming along to help you get educated on that journey of being a property investor. So a couple of things that the Institute have brought out in specific in that paper. Now, I think the easiest way as a property investor to understand exactly what this depreciation means, or really what it means in dollars, because as investors, that's why you're buying property, to make money, makes a pretty big difference. Let's run through a pretty simple cash flow. I've got some tools there at the end that I'll show you that help you to do this on your own properties or properties that you are thinking of buying. But all I want to do with this piece here is demonstrate what happens if we claim depreciation, what happens if we don't claim depreciation, what difference does it make to your cash, and then we'll get through to how that actually works. But let's take this simple scenario here. A new 4-bedroom house, let's say it's bought for 400. Nice if you could find one of those these days. They don't exist anymore. $820,000. They did when I started. So much longer ago. $820,000 purchase. Now, what we want in order to get some money for this is our rent. Let's say that's about $700 a week. So the income for this property will be $36,400 per year. Now, we're going to have some expenses in order to hold on to this property. We need to pay the bank their interest. We need to pay the insurance costs. We need to pay the property management fees. We need to pay whatever strata fees if there is. Well, this is a house, so there's no strata fees. But all the costs of a property with interest rates moving up over the last couple of years a fair bit, we'd expect to be about $50,000 or $50,200. We've made a few assumptions there, but let's say that's the cost. What that means is, in order to hang on to this property, this investor needs to kick in $265 a week, or $13,800 per year, which is not great. It's a few dollars out of the back pocket. However, the situation does get a little bit better than this with that loss that is made operating an investment property. The tax office allows us in Australia to make a tax deduction for that loss against our other income. So we have a salary income as someone that goes to work, and we get tax taken out of that. Most investors in this country are on a 37% marginal tax rate. So that's what the employer would take out of your income. And so we basically then get to make a deduction for this loss against that income. And once we do a tax return at the end of the year for on that marginal rate, we'll get $5,100 back after your account does your tax return. And the cost to own the property went from $265 a week to about $167 a week, or about $8,600, nearly $700 per year. So it's a little bit better. This is a negatively geared property, but it doesn't matter if it's negatively geared, positively geared. This is my job here, I guess, is to show you what depreciation does to this. $167 a week without any depreciation. Out of a new property worth that sort of value, we'd expect the depreciation claim to be about $16,500. Pretty high deduction. It's a new property. They do get more. We'll address old properties in a moment. But what happens to the numbers now is we still got that $13,800 that we pay out. We can see that. We've now got a depreciation claim of $16,500, which is the building getting older, wearing out, the carpet wearing out, all those things. And the difference between these two deductions is that depreciation is a non-cash tax deduction. So you don't pay it out. It's for that wear and tear. We make a $30,000 tax deduction now, providing we still have some income to write that off against. We've now got $11,200 tax return. Our cost for the year is $2,500 or $49 per week. Claim depreciation, don't claim depreciation is the only difference on those two sides of that. And the difference by doing this is $117 a week. It's good to be here today and talk to investors about making sure they take advantage of that number properly. Good real estates and property managers should ask these sort of questions. Have you got a depreciation schedule done? Because it can make a big difference to the tax return, which is why we're here today to explain what that difference can be. My job on this whole page is only that $16,500 number. We're not the accountant. We don't do all this tax return. We actually just come up with that number of $16,500 based on estimating the cost of construction, doing all the work, identifying the things we can claim, and making that number as high as we can. So a very simple cash flow. I'll give you a way to be able to do those things yourself at a later date with a little free app that we've built called PropCalc. I just want to not run through another whole cash flow. Hopefully you've understood that. You go watch it again, if not at a later date. I just want to bring to attention the fact that depreciation is not only for new properties. It does make a difference. It's not as much depreciation, but we look at this property here that's been built in 94 and just purchased now. $275 a week based on those is what it would cost without depreciating. The depreciation on this one's a bit lower, $7,800, but it still makes a difference of $55 a week by just claiming that depreciation on a second-hand older property built in 94. So it's 20 years old. It's not brand new. There are still deductions there in some older properties. Always ask the question of the quantity surveyor if there's going to be any money there before you worry about the age. It's not as much, but there's still some signs of deductions there. And I'll, I guess, give a bit better way to understand that here by giving a little bit of technical without giving too much technical, because really you just need to know it's there and get it. But the depreciation I've called so far is actually split into two areas. And the first of those is what we call, or the tax office calls, the Division 43 deduction, which is a deduction that relates to the structure of the building, the concrete floors, the walls, the roof, the stuff that lasts a long time. In order to claim this deduction, your house needs to be built after 1987 at the moment, or had some renovations after 1987. So the way this one works is, we'll use the example here. If a house was built in 2014 and it cost $300,000 for the structural part of the house to get built, you would get a deduction each year of 2.5% of that, and it goes for 40 years. 2.5% of $300,000 is $7,500 per year. Obviously, this relates to the construction costs, which is an expensive part of the building, concrete floors, walls, roof. They cost a fair bit. So new properties, existing properties, if they get this deduction, they're built after this date, or they have a bunch of renovations after this date in 87, then you get this deduction. Now, if this property you buy now in 2024, you still get $7,500 per year for another 30 years. So the first 10 years is not your claim because you didn't own it, but this is $7,500 per year for 30 years. So one thing about the age of properties, if it is built after 87, it will get this part of the deduction, which is quite high and means some substantial dollars. So the age kind of matters there. But I still want you to not worry about age. Ask us about old properties. We'll tell you whether we think there's deductions there, because it does happen for renovations as well. The other part, plant equipment. Things that don't last as long, the tax office puts an effective life on them. Remember that term effective life for a little later. I'll give you something that's interesting about that. These are things like dishwashers, blinds, curtains, security systems. The things that don't last as long, the tax office allows you to claim them quicker. So over their effective life, effectively. And they would be things like a dishwasher here in the example, $1,360 value, gets 25% of that, or $340 in the first year. It goes down over time. There's a few other intricacies, and whether or not you can claim this has a few rules around it. Uh, at the moment, since 2017, actually, in order to claim these things, they need to be new or not previously used. So that's one of the reasons new properties gets a bit more deduction, because it actually gets to claim against these things. Older properties, if you put more of new things of these in, you can claim against them. If you've had it since before 2017, you can claim against them. But we look at all these things and work out what you can claim, what you can't claim, and work out how to maximise those deductions and make sure it's worth it before we go ahead and do that. Bit of an idea of what sort of deductions come out of properties that we did in the 24 financial year. Yes, 23, 24. The next one's not finished yet. As you can see, the new properties are nearly half of the jobs that we do, and the average in the first year is $16,600. The interesting thing is those bands, I guess, the old, the little bit old, the more old, the percentage of the total of them that we do. A lot of people are buying investment properties by the looks built between 04 and 2016 there, or that's the spot we've got a lot of them, but they still get deductions that are quite substantial, $7,000, even those 87 to 03, because they get that building allowance, $5,800. Now, the old, built pre-87, I gave you that 87 date to understand when you're looking at properties, it gets more, but there's still a few jobs in there that get, in the first year, this is the first year only, $3,800. It's only 3% of our jobs, not a large amount, but it does mean, regardless of the age of the property, you should ask the question of the quantity surveyor, do you think we'll get any deductions out of this, before someone at the pub tells you a different answer? And we'll tell you whether you can get it, you can't get it, we won't do it unless it's actually going to be worth it and you get some money from it. Renovations. I'd like to touch on renovations because we all have seen a renovation show or two and thought about, buying properties and renovating. It sounds like fun. I've done lots of it. It is fun sometimes, not so fun sometimes. We found through COVID, with about 100,000 properties that we, held on to and inspected once we could, which is where we did this study, that 66% of the time they had some sort of renovation or addition done after they were built. This is how some of those older properties get more deductions. Also, using just the actual costs that are there from original may not always be the best, because there's other things that may have been added afterwards. It's one of the things that's important about a site inspection, making sure we identify everything that's there that we can claim and maximising the deductions for those things. What do renovations mean for property investors and depreciation? Two key things to consider, and the second at the page there is probably the easiest. When you spend more money on stuff, there's more construction costs or more construction money spent, then there are more things to claim, and therefore there's more depreciation to claim as the investor. So always after you do a renovation, you think, okay, I need to update that depreciation schedule. But the one at the top there is what you really think about as an investor, and it is something called scrapping. So before you rip it apart, make sure that you either call the quantity surveyor or you've got a depreciation schedule in place. And the reason for that is this scrapping. If there's anything that still had some value left when you do that renovation from a depreciation point of view, then when you throw it away, whatever value is left can possibly be an instant deduction in that financial year when you throw it away. So instead of continuing to claim it until it all runs out, because you've now thrown it away or scrapped it, it could have some value, and it would be an instant deduction in that year you throw it away. Can mean some big deductions in the year that you actually do that renovation to help, I guess, those cash flow things when you're doing renovations and spending lots of money. So if you're renovating, call the quantity surveyor first is the key thing to take away from that, because before you chuck it away, let's see if it has some value. We'll tell you if it has some value before we go out and do anything, before it costs you any money. Commercial properties, I know we're predominantly residential discussion here, but however, if you do have commercial properties, you run a business from a business, a restaurant, a cafe, a warehouse, whatever it is, any commercial property gets depreciation as well. If you use it yourself for your own business, it still gets it. It also doesn't have those rule changes for 2017 with the plant and equipment. So the age and when you bought it doesn't affect it as much as it does sometimes with residential properties. Hotels, pubs, my name is beer, so we like to do those and sample where we can. And lots of farms been done over the last little while, but just make clear that commercial properties also it's available. Now, I'd just like to address what often the frequently asked questions are here. And I think if your property manager ever says, have you got a depreciation schedule? Have you thought about that? We understand it means money. Your first two responses as a property investor are probably this one here, firstly. Doesn't my accountant look after that? And the second one is, but it's old, will I get something? I think we've answered the second question. Always ask the quantity surveyor and see if there's any deductions available. They'll look at it, see if there's something there. Don't worry about the age. Ask the question first. The first one, doesn't the accountant look after that? As I said, we work alongside the accountants. They're our friends. Most of the work we do is actually referred by accountants, and people trust their accountants with the tax returns. A good accountant should have a quantity surveyor alongside them to do this depreciation piece, because we visit the property, we can estimate the costs, and we come up with the maximum of numbers. If your property manager or the organisation is asking you about depreciation before that, they're just trying to help you to maximise the returns from your investment property that they're managing for you. So that's a good thing. A smart real estate agent or property manager is the one that will ask that question. They don't know everything about it. We know a lot more about depreciation than they do. The fact that they know it's there is a good thing, and they're asking that question. And the accountant, feel free to talk to the accountant about depreciation before you do it. The accountant should be doing it, should have it organised. If they tell you it's too old, maybe you should ask us. But we work alongside the accountants. You don't do anything that your accountant doesn't like. They're our friends. Furniture is plant equipment, so if there's furniture in there, we need to think about that. Important point, the last one. Can I claim it back in the past? Do I miss out? One of the things is that we've found that 75 or so % of people are not maximising the depreciation deduction properly. A lot more are these days than they were when I started. They don't look at you quite so blankly. If you haven't been claiming deductions that you could, you can go back. You can adjust your tax returns for 2 years. So if you haven't been claiming it because you didn't know, you thought it was old, or whatever reason you haven't, or even if you haven't been maximising it, and this is the thing, if you've got something being claimed and we think it should be more, then you can actually go back and claim the difference. So go back and amend your tax returns. Now, if you cast your mind back to the table where in the first year, the average of new properties was $16,000, if you've got a new property, you've been missing it, and you've missed it for a couple of years, you might want to go back and get that. Even those second-hand properties that had $5,000, $6,000, $7,000 a year, these are real decent-sized deductions. The important thing now is you can only amend 2 tax returns. So if you're about to go and do a tax return and you've got a property and you're not sure whether you're claiming it properly, let's have a conversation about it now so you don't do another tax return and you can't amend those last 2. So even if you've owned it for 4 years, 5 years, 6 years, you can't go back 6 years, but you can go back 2. So the simple thing to start with is talk to us about what sort of deductions might be there, compare, which is free to do to start with. Compare that to what you are doing, and if there's a difference, let's look at doing a depreciation schedule, which does cost you some money, and see if you can go back and amend those couple of years. It's well worth it. There's a free calculator on our site to estimate what these numbers potentially are, but don't do another tax return and miss out. Important things to be included. Get back to a little bit of technical. We project it for 40 years. You get access to my BMT, which I'll touch on in a moment. Total cost for the items. There's a few methods. If you want to read up on those, you can, or I'm sure we've got some case studies, diminishing value, prime cost, pooling schedules, split reports, split up for multiple owners. They're just different ways of claiming, and different split reports helps individual owners get more deductions when you split between ownership. We do all those in the reports, so they should all be there. If you want detail about that, we're not going to get through that in 30 minutes. We send copies to the accountants. They're in CSV, PDF, and Excel, so they can hopefully download some of them into some of the software quickly. Things that need to be included, I guess, to help maximise those deductions. You own part of the lift, the underground car park, all that stuff, that common area, you own a piece of it. So if it's there, you need to make sure we claim it. Furniture's plant. The more plant we can find, plant equipment, the earlier the deductions we get, especially if it's the stuff we can claim. Then to make sure we know what's going on, know the rules, liaise ATO, and the way we come up with the cost for depreciation, which I could explain in detail if you wish, but it just is a method that isn't just using about actual costs, it's actually the cost of getting the items there to help maximise those deductions. Things we make sure of, and I guess probably the one main thing to bring attention to here is the guarantee of double the fee or you don't pay. When you've got an older property and you're not sure if it's worth it, we'll have a conversation with you about that property. We'll have a look at the photos and we'll give you an idea of what deductions we should be able to find. We've done nearly 1 million of these things, so we should know whether it's worth it before we go through all the work. We'll tell you that up front. If we're wrong and we can't find deductions that are twice what the fee is in the first year, we'll just cancel the job and move on. We do have to do inspection. We try to identify this before we do the inspection, but there is a guarantee to make sure you don't spend money and get nothing. Because I touched on the first year average being about $11,000. We always do inspections. They're always my staff that do inspections. We don't outsource that piece of the process. I think that tries to make sure we keep the quality and the service there, and you can always call me if there's any issues with those things. Do them all over Australia, make sure they're compliant, and the fee is tax deductible. Now, just like to bring a little bit of attention to my BMT here, a thing that makes it easy for you to manage this. We built this, it's a portal, and the idea is that you can share it with your accountant firstly. There's 180,000 or something users on this portal where you can actually see your schedule, see the process, see the progress, and then share it with your accountant and a lot of the accountants have their login and they can see all their clients' reports. The other thing is about updating your schedule to be live. Once I do the schedule, I give it to you for 40 years, but 3 years later you put a new stove in, then obviously that stove I don't know about yet. You can go into this portal, you can add your new stove, update the schedule, the new numbers get shared to the accountant, and it doesn't cost you anything. So it's a way to have a live update to the accountant on a yearly basis to make sure it's all adjusted when you put new things into the property, when you do minor renovations. If you do a major renovation, we might need to come and have another look at it. That might cost a bit of update fee to get it right. But the minor things that you put in over time, you can upload them, you can do them for free. There's places to upload receipts, track your income expenses overall. It's in the MyGov format, the income expenses tracker. You can put your things in there that you've spent over the year, share it with the account at the end of the year in the same place, and it's in the form ready to help with your tax return instead of a shoebox full of receipts. All these days, it's 1,000 PDFs provided. Market data, planning applications that are happening around your property, valuations, the AVMs like the banks use, a lot of the automatic valuations are also in there on the property that you've had in that portal. We try to make some tools in there for property investors. Touched on that one already. PropCalc, just like to touch on this quickly. This is the tool where you can actually go and calculate that cash flow on your own property or a property you're thinking about buying. So as an investor, I think one of the really important things is to crunch the numbers. What is this property going to cost me to own, to buy, etc. PropCalc can help you actually compare that, facilitate you to add an important thing in there, which is a depreciation number. It either drags one in automatically or you go to the calculator and it'll give you some sort of estimate of what sort of deductions might be there. Free tool, you can compare properties, etc. when you look at them and help yourself crunch the real numbers on those. Touched on effective life very quickly. This is something that your property managers often use, and it just, I guess, gives you some understanding. These slides are available of the way assets are treated when there's damage done in tenancies. That effective life the tax office puts on these items here, there's 160 or so, 170 of them in a residential property. When there's an argument at the tribunal when things are damaged by tenants, the way they actually calculate the life of those is based on the same tax office effective life. We've built an app called Resi Rates that has the effective lives, and effectively, we can see here something like carpet has a life of 8 years, the tax office says. If the carpet is ruined by the tenant after 4 years, and you have to go to tribunal and argue who owns it or who has to pay for it, if it's 4 years old, it's halfway through its life, and they'll generally work out that it'll be half each. And this is based on those tax loss effective lives. And you can see them here. This tool is largely for property managers. It's free, but so you've got some understanding, and there's some rates and ideas that are on those to make that easier as well. A few other apps for investors, free apps everywhere. Resi Rates is the one we just talked about there. Depreciation calculator, prop calc we discussed. Construction costs. If you think about building stuff, we're quantity surveyors. We publish some construction costs. There's an app there that can help you get an idea of construction costs. Or rep cost, which is replacement cost for insurance. Once again, quantity surveyors. How much do I insure my house for? I don't know. Well, you can use that app, and it can give you some idea of what it should be insured for by putting some information in there. Process of doing it. We talk to you about it. We work out when and see if we can get some money for you, get some basic details. We organise the inspection. We'll pick up keys from the property manager if we need to, organise with your tenants, do the report, start claiming lots of tax money is the plan. So it's pretty simple. We're on site for 20 minutes or so, and a simple process for you as the owner of the property. With Biggin and Scott, as I said, they get nothing from us in doing this other than they want their clients looked after. Based on numbers we do with them, there's a bit of a reduced fee there. It's normally $770, $715 for Biggin and Scott clients. So I mentioned that, and we'll honour that as a slightly reduced tax deductible fee. That brings us to the end of the day, and I think we're right on the time. I hope that brought some valuable insight on how to get more money out of these properties for you guys as investors. And I guess if we've got time, some questions. Is Paul still there somewhere?
Bradley, I think what we'll do is we're videoing this. So first of all, thank you so much. Our goal today was to help investors get better educated about where they can reduce the cost of a property, and especially in Victoria at the moment, where it's it's a bit of a burden. You've pretty much answered most of the questions that I usually throw at you, because the big one is, if anybody watching this thinks that their accountant is doing part or they're partially doing this, the answer is no. It needs to be in conjunction with quantity surveyors, so that you're getting the full tax depreciation on the building and the plant and equipment. I'd like to thank you again, Bradley. We'll get this out to everybody. We'll put it up on YouTube, and we'll send it, no doubt, to all of the investors in Biggin and Scott. That was the goal of today, to show them that there possibly is a better way.
Thanks, Paul. Great to be here. Love talking tax depreciation.
Thanks for watching, everybody.
Thanks, Paul.